Welcome, everyone. We are going to give everybody a few moments to get logged in to our call, and then we'll be getting started. So thank you for your patience as we just await people to log in, and then we'll get started. We're going to give everybody about 3 minutes here to get logged in to the call, and then we'll get started. John, is that background from our office?
It is. Let me see if my putting headphones in alleviates it.
That would be great. Thank you. Okay, we're going to go ahead and get started. My name is Lorraine Gilbert, CEO of WealthWise Financial, and we are here for another WealthWise Viewpoint webinar series. And we are so excited to have JP Morgan here giving our presentation on retirement. And so they are going to do about a 30 to 40 minute presentation. Following that, we're going to have John Milligan, our Director of Investment Strategy, who's here doing a short overview of the tariff turbulence, as well as an update as to what we are doing proactively on your behalf in the portfolios. So with that, Quinn, I want to thank you, Quinn Early from JP Morgan, in helping us host this webinar, and love for you to introduce our presenter.
Thank you so much, Lorraine. Good afternoon, everyone, and thank you for joining us here today. My name is Quinn Early. I am an internal client advisor here with JP Morgan Asset Management, and I am joined by my colleague, Alex Nobile. She is a retirement strategist on a retirement insights team here at JP Morgan. Within Alex's role, she's responsible for researching and delivering timely retirement insights on topics such as retirement savings, Social Security, Medicare, and many, many more. I know Alex has a lot of really good stuff planned for everyone today. So with all of that said, Alex, I will pass it over to you.
Oh, and you're muted, Alex.
Thank you. Sorry about that. Thanks, Lorraine, for the opportunity to be here today, and thank you, Quinn, for that introduction. I am going to go ahead and share my screen. Make this bigger. All right, and just want to take a moment to thank all of you for your time today. So today I'm going to share some of our top slides from our Guide to Retirement. We at JP Morgan have been creating the Guide to Retirement for over a decade now. This is our 13th guide, so a lot of good information here. Excited to share that with you today. I know right now, everything going on in the market, Lorraine, you mentioned the tariff turbulence. It can be a really daunting time to think about retiring, especially if we're near retirement or even in retirement. And so my goal for today's session is for you to leave here feeling more empowered, more knowledgeable, as you're having more conversations with folks like Maureen and your advisors, just feeling like you understand, right, a deeper level, and can go to those conversations asking the right questions and just feeling more, well-informed. So let's get into the agenda for today. We are going to first take a look at really the retirement equation, is what we like to call it, focusing on what you can control and what you can control, and really where we want to put those efforts into when we're thinking about our retirement plan. We'll talk about through our retirement plan and ways that we can navigate that. For example, thinking about goals-based wealth management, bucketing our money based on goals and time horizons. And then in the second half of the conversation, some key components we'll focus on that really are important when it comes to crafting our retirement plans, like Medicare, long-term care, and Social Security. So let's get into it. So this is one of our first slides in the Guide to Retirement. It is the retirement equation. I always joke, lucky for me, it is not a math equation. It is just a simple kind of looking at the components for retirement, broken down by the areas that we can control, where we have some control, and then in blue, right, where things are out of our control. And so starting in green, the areas where we have some control, right? This is the things like employment earnings and durations, how long we're working and our income, longevity, right? How long we can make some choices that can impact how long you live, but we don't really have control over these things fully. Then there's things that are out of our control, like the market returns, right? This tariff turbulence, thinking back a few years ago to 2020, another period of extreme uncertainty, right? The market, we cannot control the market, but we can have a plan and we can work with our advisor to adjust that plan and reevaluate the plan, right? As the market scenarios unfold. We also have tax and benefit policies, again, things that we cannot control. We can vote people into office, but we can't control these. And so best to focus on the areas in purple where we can control, right? Our asset allocation, how our money is invested, and the types of accounts that they are invested in, specifically the tax treatment of these accounts. And really the most important thing, right? How much we're saving, and saving, knowing how much we need to be on track for a secure retirement. So again, where we want to focus our efforts are these areas in purple. And I know that this is really something that's easier said than done. I'm a relatively new parent. I have a 2-year-old and a 6-month-old. And so just thinking about, I get this advice a lot too, right? When I'm stressing about things that, to maybe older, wiser parents don't seem like that big of a deal, but sometimes we get caught up in our own heads. And I think it happens when you're a young parent, probably as you're a middle-aged parent too, and even more so as we think about retirement savings. So it's something that we really like to continue to remind ourselves, right? Just focus on what we can control. All right, and so now that we've talked about that, let's talk through creating a retirement plan. All right, so when we think about creating a retirement plan, we like to start by thinking about income replacement, right? And so income replacement, what is it? Simply put, it's the amount of your income that you need to replace in retirement to sustain the same standard of living. This is going to be a little bit different for everyone, right? We all have different lifestyles and different preferences. This is just a snapshot of our Chase data. So at JP Morgan, we do bank half of US households through Chase. And so we are able to look at that anonymized, aggregated data and get some insights from that data. And what we've seen at a very high level, right, looking at different retirement incomes. So the bottom here, you can see this is pre-retirement incomes at the household level, ranging from $30,000 to $300,000. You can see the overall replacement rate does tend to shift in looking at spending. So we look at, for example, a $100,000 household potentially might only have to replace 76% of income in retirement. What we see.
Can I add something to this, Alex? What I love about this slide that you guys show is the impact of Social Security as a percentage of the overall replacement. And so what's significant is that the more money you make, the less Social Security is going to replace your income. Therefore, for those people who do make $300,000, $400,000, $500,000, they're going to need to have private investment or a pension, but very few people have pensions. It's now really resting on saving that money to replace their income. And to me, that's one of the most significant parts of this chart.
Definitely. You can see right at we only have up to 300,000 household income level here, but you can see it's a much smaller percentage, right? Only 14%. So definitely as that income increases, less and less able to pull from Social Security. And that amount that you need, right, from the private employer source, how much we're saving is going to increase. And so this is what when we think about how much we need to save for retirement, sorry, I'm jumping ahead, how much we need to replace, that goes right into our retirement savings checkpoint chart. So this chart, we joke about calling this chart the heart attack chart, because sometimes the first time people see it, they can get a little bit shocked, like, oh, this is how much I need to have saved, especially when we're talking to younger folks. And how you can read this chart is simply find your current age on the left-hand side and then match that up with your household income. So just for an
So
example.
let's just look as an example. Which one do you want to use?
True. We typically use a 40-year-old, right? A current age of a 40-year-old. If they have a household income, we can jump ahead here, say $175,000. By the age of 40, they should have saved, that level is $305,000, right? So that's the checkpoint to be on track.
And similarly, if that same 175,000, you're 60 years old, you need to have 1.185 million. So this is a great chart to use just as a checkpoint at different ages and different income levels. Are you on track?
Yes. And it's also really important to point out here, Lorraine, that this is based on the model assumptions to the right. And this is based on a 10% gross savings rate for retirement age of 65. So if you are saving more or less, you want to retire sooner, later, if you just have different needs, right? You want to maybe have more saved so you can do all of this trip that like one trip isn't going to break the bank, but if you have a different view for your retirement, right? A long-term travel, all of these things are going to go into your specific plan and your specific number. This is a really generalized checkpoint chart, which is why it's so important to work with an advisor to really craft a plan that it's going to work for your needs and your specific goals for retirement.
One other thing I want to add in here is it's assuming you're not touching this money until you are 65. So it's the idea of that money continuing to have money go into it, not just a static amount of money that's growing, but money that you're actively contributing into with that 10% of income and not touching it until age 65.
Yes. And if anything changes, right, we always say it's so important to create your plan, work with an advisor. But then if anything changes, we need to rerun that plan, right? If one person decides, if you're in a two-person household, one person decides to take a time off of working, right? We need to recalibrate and relook at the number because things are going to change. So this is just really, we call it an old-fashioned paper map. It'll get you to the vicinity, maybe the town you want to get to. But if you really want to pinpoint your exact landing point, you really need to have a more personalized plan.
And of course, that is exactly what we do with our clients in the financial planning process, that every time we meet with people, we are reviewing their wealth vision, reviewing all their planning, looking at Monte Carlo simulation, making sure that those numbers are looking good. And if they're not, making a course correction to make sure that we are on track.
Yes, that's great. Sometimes I sound like a broken record because it's so important, right? To look at the plan, create the plan, review the plan, rerun the plan, because life happens, right? And you might not have all of the information that you need when you start your retirement planning journey, but each year you get closer and you're able to refine it, and that makes all the difference. All right, so another thing to think about when we're thinking about planning for retirement is how we are going to have changes in spending in retirement. And so this is again based on our Chase household data. And I always think it's really interesting to see because again, we're able to aggregate all of this data and we can see how households spend throughout their life. This is a snapshot starting at age 45, going all the way out to 95 years of age plus. And so you can see that household spending peaks, call it around age 50, when families are potentially the largest, before kids maybe have gone off to school. And this is where, again, we're going to see our income levels, or the amount that's being spent, excuse me, not income, the amount being spent really peak. There is a gradual decline as we, at the beginning of retirement, right? This is where we're going to be spending the most money. We're thinking about our planning, if we want to take any trips, make any big purchases, right? Often these are going to happen in the earlier years of retirement. We
I
do
would say
see,
that that corresponds with what we see with our clients. I will say most of our clients do a lot of travel in retirement up through later years. We have some clients, we're actually doing a cruise, our WealthWise cruise this fall, where some of our clients are going on a cruise. But I do think that we see more travel for longer, and in our planning, we actually use that usually through age 85, usually around maybe 85 is where we see clients starting to slow down on as much travel, that is.
yeah, that makes sense. One thing that's interesting here to look at, this is broken down by category, right? Healthcare, charity and gifts, food and beverage, and transportation. And we mentioned travel at the top as well. As we get older, one line item that tend to go up is healthcare. So it's something that we want to plan for. We'll talk about it later today, thinking about Medicare costs, potentially long-term care. So this is something just to keep in mind, because we'll want to make sure our money continues to grow and that we have saved enough to potentially account for this increased spending in healthcare as we age.
What else is interesting about this chart is it shows that the charitable giving seems to increase as people get older.
Yes, definitely. And
Part
we've
of
seen,
that, go ahead.
uh,
Oh, I was going to say, one of the things for our clients to remember that we utilize quite a bit is when making required minimum distributions later in life, if you don't need that income as taxable income that you're going to be using, we do a lot of direct charitable donations from IRAs, because that will satisfy your required minimum distribution by giving directly to charity up to $100,000 a year.
yeah, it's definitely a great resource. Great thing to do. All right, so one other section when we think about spending in retirement, and again, this is why, again, I sound like the broken record, but it's so important to work with an advisor. When we think about those first few years before we reach retirement and the first few years of retirement, our balances are likely going to be the highest, right? And again, we've worked our whole careers, we've saved such a large chunk of money for retirement. But these first few years leading up to retirement and into, if they can be really important, right? We want to make sure if there are periods of volatility, we want to make sure we're invested the right way so we can weather that volatility. And what this slide shows is that sequence of return risk at the beginning of retirement. So how we'll look at it is this up top. This is taking a look at a retirement portfolio of $1 million. And we're modeling out here a 4% withdrawal rate. So if you're working with an advisor, right, your withdrawal rates might be different. This is just a standard kind of, so we can, for illustrative purposes. So what that looks like perhaps is you're taking, again, 4%, about $40,000 a year, adjusted for inflation. And so in this gray line scenario, if an individual starts with that $1 million, and we jump down here looking at the returns, right? In the market, if they get an average 5% return, which we know never happens, right? The market doesn't just give us a 5% return for 30 years, but just looking at that 5% average return, accounting for those withdrawals that we talked about, you can see that $1 million, how this is going to, the portfolio will potentially last. This is, again, based on those Monte Carlo simulations and taking a look at the range of returns. But potentially, right, this individual is going to end up with $631,000 30 years into retirement. Now, if we have someone who had a great start, so looking down at the scenarios, they were up 20% in their first year when their balances were the highest, had a few good years, and then there was some volatility, and end up with a bad start. Or a bad ending. They were down 20% that last year in retirement. Didn't really make much of an impact, right? They had that great start, they earned a lot of money, and they ended up with more than they had at retirement, right? 1.6 million. On the flip side, individual who has a bad start, right? Looking at this slide, they were down 20% when their balance was highest. They actually end up running out of money at year, call it, 23, 24 in retirement. And so how do we mitigate this risk? And of course, this is because if we're taking money out during these years, we're potentially locking in these losses, right? At a time that is so important. So how do we think about mitigating this, right? it is so important to work with an advisor to make sure that your money is invested appropriately. We'll talk about this later, but thinking about goals-based wealth management, right? How to manage our money based on particular goals, short, medium, and long-term goals, and potentially having, right, that cash kind of savings that you can tap into in those earlier years, of retirement. Just having that buffer can be valuable too.
Yeah, I'd like to add here. So a couple of things that we've seen to really help clients avoid the potential for that latter scenario. Two things. One, part-time work at the beginning of their retirement, either sitting on a board or doing some part-time work, doing some consulting, something like that, that supplements the income at beginning of retirement can end up being very beneficial for the long haul, because you're not going to want to do that later in your retirement. So do it early in your retirement, kind of a good way to jump from full-time employment and then doing something consulting part-time, something like that. The other thing that we've seen that's been helpful is taking a part of your retirement savings and using a guaranteed income stream off of a product like an annuity that can give you, no matter what happens in the market, a baseline amount of money. So those two things we found have been helpful.
Yeah, that's great that you pointed that out, Lorraine. I think we've seen in some of our research, I don't have it on this slide, but when people do have some sort of guaranteed income, they feel much more comfortable kind of weathering that volatility, spending money, right? They just feel more comfortable and confident if they have those basic needs met. So it can definitely be a really, really valuable tool. All right. So again, create the plan, reevaluate it, rerun it, work with your advisor is really the most important thing to do when it comes to weathering volatility. So let's shift a little bit. And while we're talking about volatility, and we'll talk about goals-based wealth management, but this is slide 40 from the Guide to Retirement, and it is one of our most popular slides in the guide. So I did want to take a moment to touch on this today, because it is especially timely given the volatility. So this slide is our impact of being out of the market slide. And what it shows is the returns of the S&P 500. So specifically the performance of $10,000 invested between January 3rd, 2005 to December of 2024. So we're looking at a 20-year time frame. And if this money was fully invested during that time, right, you earned 10.4% returns, right? Now, what we've seen looking at the data is that often some of the best days in the market are immediately followed by some of the worst days are immediately followed by the best days. So we can see here, looking in this time period, 7 of the 10 best days occurred within 2 weeks of the 10 worst days. 6 out of the 7 best days occurred after the worst days. So right after, right, we have a crazy day, a dip in the market, and then the next day we see great performance. The second worst day of 2020, again, looking back to the COVID times, and I remember my mother-in-law actually retired right before COVID, so at the end of 2019. And so obviously that was a really scary time for a variety of reasons, but especially if you're retiring during that time, seeing your balance fluctuate, it's really scary. She was calling my husband constantly. He also works in finance. Just, what do I do? What do I do? And just kind of re-messaging to her, right? You need to stay the course. We showed her this slide and again, it was a different version, but you can see here the second worst day of 2020, which was March 12th, was immediately followed by the second best day of that year. So we talked this through her, right? Stay invested. You can't pull out now. You're locking in your losses, and you're going to potentially miss out on that correction, right? When the market goes back up again, because it always.
And we just had that happen. Just in the last couple of weeks, we had some of the worst days, and then followed by some of the best.
Yeah, and actually last week, we just reran this last week because it was April 9th, I think it was Wednesday, maybe Tuesday, was on the updated version of this when we reran the data, ended up being, I think it was the third best performance. So what we see, right, is if we were to pull out, right, we're locking in losses, then we don't know, you need to be able to get back in, right? Maybe you have a crystal ball and it could tell you, you need to get out now, but then you need to be right twice. You need to be able to know when to get back in so you can get that performance. So it's a losing game. And we have kind of two mottos when I get to this slide. It's time in the market, not timing the market. We'll talk about that on the next slide, right? Time in the market, staying invested, staying the course is the most prudent approach. And in this chart, you can see if you stayed fully invested, you earn 10.4%. But if in that 20-year span, if you just missed the 10 best days, your returns were nearly cut in half at 6.1%. If you miss the 20 best days, again, cut in half, 3.5%. So really, we want to stay the course. And again, continue to reevaluate, make sure that your plan is on track based on your goals, but stay the course, right? That's the most important thing. And when you're working with your advisor, right, you're going to think about what are your short-term goals, your medium-term goals, right? Thinking about short-term goals like emergency savings. We want to have enough cash on hand. That's going to be bucketed in one way. Medium-term goals, potentially if you're paying for college for children or a home purchase. Our longer-term goals, right, potentially retirement. And so we have this money invested based on these goals. And so if nothing has changed based on your goals, then you don't need to necessarily, right? You don't need to change your approach. Working with your advisor is the most important. Stay on track. So what we can see down below is if you look at, this is the range of returns for equities, bonds, and a 50-50 bonds and equity portfolio, as well as cash. And really specifically, right, if you look at the range of returns for equities, they can be quite volatile, right? Looking at the 1 year, it's a broad range of returns, potentially up 52%, down 37%. But as you look out 5 years, 10 years, 20 years, that's going to smooth out. And so again, it's important to stay invested for the long term based on your goals.
The other thing, I'd love to point out here, if you focus on that blue line of this, which is the 50-50 allocation, which we tend to use either 60-40 or 40-60, but what it shows is that even a moderate approach at 50% in stocks and 50% in bonds over time, I mean, look at that number on a 20-year rolling average is 14%. I mean, solid numbers in a 50-50 allocation.
Yeah, no, definitely. It's a really great thing to point out. And the other saying I like to talk through on this slide is our chief economist, Dr. David Kelly, often says that your portfolio is like a bar of soap. The more you touch it, the smaller it gets. So we don't want to touch it. We don't want to move things around too much, right? We want to stay invested because that will be the best long-term approach. Okay, so we're about halfway through now. So we made it here so far. Thanks everyone for staying with us. Now we're going to focus a little bit, shift gears a little bit to know what to expect from Medicare, talk through long-term care and Social Security. And of course, all of these things are really key components to our retirement plan. So first we'll start with Medicare. And here we can see the main goal of this slide is to show you how healthcare costs are projected to increase, right, as we age. So looking on this slide, we did model out here original Medicare in $2025. This is the cost per month per person. We chose original Medicare. There's also some less expensive options. Medicare Advantage has been gaining in popularity, so that's going to be a little bit less expensive. But with Medicare Advantage, there are some restrictions, right? You have to choose from a network of providers. And if you have 2 homes, for example, there are geographic requirements. So we decided to choose original Medicare here to map out. And we chose the most expensive, right? The most comprehensive plan just for illustrative purposes. So this is Medigap Plan G. And so what we see on this slide, right? Looking at age 65, using Medigap Plan G, and Medigap is going right to cover those gaps in coverage. It's a supplemental policy to fill in the gaps not covered for parts A and B. So we can see the breakdown of costs, right? Medigap Plan G, in purple, other out-of-pocket expenses, because with original Medicare, vision, dental, and hearing are not included. Part D premiums and out-of-pocket prescription costs, right, for medicine. Part D premiums, doctor's tests, and outpatient hospital insurance. Part A is not included here because that is free for most individuals, but Part A covers hospital stays. And so you can see at age 65, that amount with this Medigap Plan G original Medicare is about $572 a month per person. Now, if we go ahead 30 years with this same plan, the cost is expected to nearly triple, right? At $1,600 a month per person. So why is this, right? As we age, we need more medical attention. Our supplemental policy, the premiums for Medigap Plan G are going to become more expensive. And so we're needing more services. These costs are going to increase, or premiums are going to increase. And so it's really, really important to make sure that we have enough money to cover these rising expenses. And again, making sure we have this.
Here, Alex, is this including or not including the long-term care cost for those kinds of needs?
This is not including long-term care costs. Yeah. It's a really important thing to point out, and we'll talk about long-term care. I think that is that our next section. It is indeed. So a good transition. And it's a really important thing to point out because long-term care is a really variable expense, right? Not all of us might need it, but if you do, it is an expensive thing that we need to make sure that we're prepared for. Often too, not on this slide, but long-term care needs are potentially women tend to need more long-term care because they do live longer than men, and they're more likely to provide unpaid care for their male spouses. And so then they need that additional level of support. And so it's important to factor this in, right? And to make sure that we have products to make sure that we are set up for success in retirement, and to keep this into account and talk about it right before it becomes too late. So thinking about, just looking at disability overall, just looking at some stats, this is the percentage of the population age 65 plus who will need assistance with 2 or more daily living activities or have severe cognitive impairment. So at age 65 to 69, only 5% of the population will be affected. If we move up to age 80 to 84, up to 20%. And then 90 plus, just about half of the population is potentially affected. The good news is, right, the other half of the population is not, right? It's half of the population. Just we don't know what's going to happen, right? We don't have the, so we need to be.
One of the statistics that I remind people is, well, 2 things. That if you're single, you have a very, there's a huge risk here if you're single because you don't have someone else in the household who can take care of you. And then if you're married, the probability of one of those 2 people needing care is extremely high. We don't know which one it's going to be, but one of them will probably need it. So in both cases, whether you're single or you're married, this is the reason to protect yourself from those costs that end up happening later in life.
Yeah, it's really, really important. We do have listed here a variety of long-term care planning options. And it's also important to keep in mind it's generally a progression of care. So perhaps while you're younger in retirement, you can have family, like Lorraine mentioned, can potentially help out friends. But if you do need more, varying levels of care, that does increase as you age, you're going to need to be able to be financially prepared for that. And so on this slide, we just list out a variety of things to consider, right? And we need to think about these things when it comes to our retirement plan, because if we do want to potentially move closer to family or friends, we want to be able to keep that in the budget. We want to know maybe the tax rate is going to be different, the cost of living where we're moving, if we're moving towards children. In my family, my father actually moved to us about 2 years ago. I'm from Pennsylvania. He moved to New York. And so it's been really great for us selfishly because he helps with our kiddos, but great for him too because, he's around. And if anything happens, he's in his older, in near almost 80. So if anything happens, we want him to be close by too. So just thinking about this and making these decisions, mapping it out can be really valuable. And you do need long-term care, right? There is going to be a natural reduction in your saving, or in your expenses, right? So that money can go towards some of this long-term care needs. You're not going to travel as much, right? There are different insurance options, like traditional long-term care insurance, combination life and annuity products are becoming more and more popular here, or life insurance for a surviving spouse, deferred annuities for income later in life. These are different strategies that can help when it comes to long-term care. Also, life plan communities. My aunt-in-law and her husband, they just moved to a community where they're able to live on their own now, but if they do need that progression of care, they can move to a different, option in the community. And they're set up socially too, right? They're able to interact with people their age, and they get a lot of fulfillment for that. And then finally, home equity. If you have a second home, that can potentially be sold to help cover some of these long-term care costs. So again, it's just about being prepared.
Right. And we talk to our clients a lot about planning for these long-term care needs and can help our clients with the options available to fund it.
Yeah, that's great. All right. All right. Our last one is Social Security. I know we are almost coming up on time, but do you want to take a moment to talk about Social Security? Because this is one of the hottest topics, and we get questions all the time from folks. So let's get into it. And we can't talk about Social Security without talking about life expectancy, right? Generally, the longer you expect to live, the more that it does pay to wait to claim Social Security. Also, thinking about life expectancy is, of course, important, right? When it thinks about how long we need our money to last in retirement. But what you can see on this chart, this is from the American Academy of Actuaries. And if you're interested, there's a link down below. You can actually go on their website and take a look at your life expectancy probability after you answer a few questions. But we've got this from them. Looking at the stats, you can see the likelihood. I'll just choose myself. I am a member of a couple. So the likelihood of at least one member of a couple living to age 85, if I'm a part of the total population, is 71%, right? So a 7 in 10 chance someone will live to age 85 in my couple. If you are a non-smoker in excellent health, and really as long as you are a non-smoker, barring any major health concerns, you can give yourself this boost. And we have seen, year over year, life expectancy has continued to rise because of medical advancements, and we do believe that that will continue. So again, if I'm a non-smoker, there's a 9 in 10 chance of one person in the couple living to age 85 or beyond. There's a 43% chance, right? 4 in 10 chance of one of us living to age 95 and beyond. So just thinking, right, how long our money needs to last. And also when we want to claim Social Security, it's a really, really important factor here. Okay, so this is our Social Security timing trade-off slide. There's definitely a lot on the slide, so I'm just going to jump to the bottom first and I'll walk you through it. But what this shows is that if you were born in 1960 or later, your full retirement age is 67. Okay, so what does that mean? Your full retirement age is the age, if you claim, you will get 100% of the benefit that is due to you from Social Security. Now, if you wait to claim until age 68, you push it out a year, you're going to get an 8% boost. If you wait all the way up and delay claiming until age 70, you will get 124% of the benefit that is due to you. Now, on the flip side, if you have to claim early, maybe a health concern, or you just don't have enough income to bridge, whatever that may be, you can do it. But if you claim a year early, right, you're going to get a 6% reduction. You can claim as early as age 62, but at that time, you'll get a significant cut, right? You'll just receive 70% of the benefit that's due to you if you claim at age 62. So
yeah, this is a very important decision to make when to start Social Security. It's something that we also run through our financial planning software to optimize when you're taking Social Security. And it's not always what you might think. It's not always one or another way, but we do need to run the numbers to see so we can help you with that on, any analysis of when you should take your Social Security.
that's great. Up here, I won't go through every single age here, but just so you all are aware, did want to touch on this. If you were born in the year 1950 or earlier, your full retirement age is a little bit earlier at 66. And you can see if your birth year was 1955, it's pushed out a little bit further, 62 plus 2 months, 66 plus 2 months, etc. And so I bring this up on this slide because this is actually an example of a benefits reduction that was put into place in the year 1983. So that was the last time there were some Social Security solvency issues, right? The trust fund was potentially going to be depleted. And so Congress pushed out the full retirement age in order to deal with that. And so I say this because it could be an example of the future. Right now the trust fund is scheduled to be depleted in the year 2035. And so that could be a one way that Congress looks to help with that, with the funding. But really, for those who are near retirement and in retirement, we do not expect any benefits reductions. And so this slide is one of our new slides in the guide, and it's our last slide for today. So again, thanks for sticking with us. But it's one of my favorite slides because it really debunks a lot of myths that we've been hearing from people. So I do want to just take a moment to walk through this. So the first myth that we hear is that young workers will get nothing from Social Security, right? So let's take a look at this. If nothing happens, right? If Congress does nothing, if the trust fund is depleted in the year 2035 and there's no funding changes made, we still have enough from ongoing payroll tax funding, right, for workers paying into the system to cover 83% of benefits. If Congress does nothing until 2098, still then we have enough to cover 73% of those benefits. So younger workers, they should rest assured that they will have something from Social Security. There is a potential for younger, higher income workers to potentially get a little bit less. Maybe that pushing out of the retirement age is a potential for younger individuals. But down below, we look at myth number 2, right? I should take my benefit now because it might be cut later. So if I'm someone potentially, in my 60s, and maybe I want to think about taking it early because I don't know if it's going to be there in a couple of years. And that is not the right way to think about it, right? We do not believe for individuals near retirement, even individuals, right, who are age 45 and up, we do not believe there are going to be any changes to Social Security for you. If we look back to that benefits reduction that I talked about in 1983, it was a reduction for those who were age 44 and younger, right? So age 45 plus were not affected. And we can see here, looking at voting rates, right? Those who are aged 45 to 65 plus, right? These people vote, we all vote at much higher levels, right? 45 plus than younger individuals. Congress isn't stupid, and they're most of the time, they don't want to get voted out, right? And so they are not going to cut benefits for people who are voting at these high levels. So you should rest assured that your benefits will not be cut. For younger workers, right? Younger, higher income workers, there is a possibility, but there will still be something for them.
Yeah, I completely agree. And just, another stat here is that if we move to age 70 for everybody for Social Security instead of 67 the way it is now, it completely solves the funding issue for Social Security. So to your point, I think a revision would be increasing normal retirement age from 67 and may also be tiered the way that they did it before, to 68 or 69, depending on when you were born.
Yeah. Well, that's all that I had today, but definitely I know we'll have time for questions later. But thank you so much for the opportunity to share.
Thank you, Alex. Thank you so much. And we're going to have John do an overview for the next 10 minutes or so on what we've been seeing in the markets and what we've been doing on your behalf. And then we're going to open up for questions. So, John, go ahead.
Absolutely. And so I'm going to take this in 3 sections. Essentially, what has happened year to date, and then kind of how we see things right now, and then a little bit of a longer term perspective on things. So if you would have watched our video that we released towards the beginning of the year, one of the points that we really wanted to drive forward was that this was going to be a volatile year. And volatility is up and down, right? And volatility can come from increased levels of uncertainty. And it definitely has been that, a more volatile year. We typically, when we measure volatility, we look at something called the VIX, which is an index that tries to measure the volatility that's inherent in the S&P 500. we generally consider a VIX level above 30 to be a volatile market in the S&P 500. And this year we saw it get above 50. So it definitely became very volatile, the most volatility we've seen since March of 2020. And if we look through the sectors, so 11 sectors in the S&P 500, the most volatility came after Liberation Day, when the administration shocked the markets in a sense by, as we see it, a little bit of a shock and awe campaign, throwing out high numbers out there, trying to get their negotiations or whatever they're trying to achieve to the table. And if you look at the 11 sectors, which ones were the most impacted in the stocks? The 11 sectors of the S&P 500, the most impacted was information technology. We came into this year underweight information technology for a few reasons, but one of them was the anticipation of volatility. And so the information technology was the most impacted sector, and the least impacted sector was utilities, which is where we have an overweight. Now, if you look at some of the things that affect these sectors, information technology has the largest exposure to foreign sales of all 11 sectors, and utilities has the lowest. And so we see that correlation to foreign sales and what it did to the prices of these. And so then the next point that we're going to talk about is when we look at bear markets or drop downs in the stock market, we got close to a bear market. We have to categorize these things internally. And so we look at them through one of three categories. It could be a cyclical bear market, right? So cyclical is when too much debt is taken on the economy. When you take on debt, you're spending beyond your means in a sense. That can happen both, within households and businesses, et cetera. You build on debt, then you have to stop your debt accumulation, and the growth of the economy has to slow naturally. So there's a debt cycle. The next one is structural. So structural is when there's a bubble, right? So like the dot-com bubble would be an example of that, or the great financial crisis. So, some kind of financial calamity that causes a structural recession. And the third one is event-driven. And so when we look at this lens here, what has recently happened in the market, we have to, make a determination, which do we think it is? Because that's important. And we categorize this one pretty quickly as an event-driven. And why is that important? Well, if you look back at history, event-driven bear markets are about a third of the duration of a cyclical bear market and about a fifth the duration of a structural bear market. They are quick to drop and they're very quick to come back. So that to us says, okay, here's an opportunity for buying. And so where we were already underweights, we were coming up with long-term expectations, because especially in the equity side of the business, we come up with long-term expectations. So a few of these areas that we do like, that we thought got oversold. So a few spots within semiconductors, a few spots within consumer discretionary, other cyclical areas that got really oversold. We started to buy that stuff back in. And so we started to get back up towards benchmark, even above in a few situations. And so that's primarily what we've been doing at this point, is buying back in. We're going to keep monitoring the situation because there's still a high degree of uncertainty and unpredictability into what's going to happen. But we are looking at it daily and making decisions as to how to go forward. And so what do we see going forward? Well, we see a little bit of the same trend that we've seen for a long time. If you look at earnings growth over the past couple of years, it has remained concentrated and within those large US companies. And that has been decreasing the earnings share relative to the remaining 493 of the S&P 500. That has been changing. And so what we've been doing is we have been over time increasing our allocation elsewhere. We took advantage of this recent dip in the markets, but even now, analyst expectations have been adjusting even more rapidly to other parts of the market. Healthcare is getting a boost. Utilities continue to be a strong performer. 5 out of 5 industries within utilities, we see better than expected EPS growth adjustment from over the past year. And in consumer staples, which has been one of the best performing sectors year to date, we get most of our allocation there. Walmart, again, an area of strong performance year to date. So we see a lot of the same, just with a layer of uncertainty that's being laid over the trends. So there will be tactical adjustments overlaid, but in general, our path of high quality fixed income, moderate duration to take advantage of the interest rate cuts, and having a wide berth exposure to a barbell of growth and value and being very selective, especially in the growth side, as to what we're investing in, is how we're going to take this for the rest of the year.
Thank you, John, for that overview. That was fantastic.
Mhm.
And what I would say to everybody here on this call, we are selectively buying. We're not indiscriminately buying. We're being very selective, very thoughtful of what we're doing, and it has been paying off to do that. And we will continue to do that. We keep you in your risk profile. So we never go outside your risk profile, but within your risk profile of however much equity to fixed income, we're going to stay in that band, and we're taking it from different places and taking advantage of these opportunities. And just like that slide showed that Alex showed a few minutes ago, is that following some of those worst days, we have some of our best days. So by taking advantage in some of those worst days, then we get the bump up in those good days. So with that, I'm going to pause and just ask if anybody has any questions. And we can't have a chat room, but I believe you can raise your hand, your virtual hand. So if anybody has a question, please raise your hand. And while we're waiting for any questions, I have a question, Alex, and that is on that link that you had for the actuarial, does that link show people at different ages? Like if somebody's 45, they can see what their expected, life expectancy is actuarial. Is that what that does on that website?
Yes, you input your birth date.
Okay.
And so you'll be able to see your specific life expectancy based on where you are today. So of course, on that chart too, right? The longer you live, the longer you're expected to live. So your age, of course,
Exactly.
will impact it as well.
And we have a client who is 105, I believe. She's our oldest client that we have alive, and I love that. She's completely with it. Cognitive abilities, all there. It's pretty amazing. Lives in, that lives really well. And so I hope that for all of our clients, that they can live a long and good, healthy life. So I don't see any questions. As always, to our clients, we are here for you, your individual situation, and whatever your questions are. So please call us or email us. Always, you can go to our website at wealthwisefinancial.com. You can email us. You have my email is LorraineG@wealthwisefinancial.com. John's is John M@wealthwisefinancial.com. We are here for you. Thank you so much. Thank you, Alex. Thank you, Quinn, for the presentation. And we look forward to talking to you again.
Thank you.
Thank you.
Thank you.